The Middle East is boiling over, and Wall Street is feeling the heat. Dow Jones, S&P 500, and Nasdaq futures were set to open Sunday evening, with Israel and Iran continuing waves of attacks over the weekend. The major indexes already finished last week lower, with the Dow Jones plummeting 769 points on Friday alone as Israel launched major attacks on Iran. The stock market rally itself fell solidly Friday. This isn't just about regional conflict, it's a direct hit on global markets, especially energy. Oil prices surged 7% on Friday as Israel and Iran traded strikes. Brent crude jumped over 6%, while West Texas Intermediate rose over 5% immediately after the attacks. This reflects not only short-term supply concerns, but also a significant geopolitical risk premium now priced into the market. Gulf markets plunged on Sunday, sparking fears of a widening conflict. The Qatari stock market index slid nearly 3%, with almost all constituents in negative territory, including Qatar Gas Transport and Akilat and Qatar Electricity and Water Company, which were down 3.1% and 1.7% respectively. Saudi Arabia's benchmark index was down 1.6% after initially plunging 3.6% at the open as stocks fell across sectors. Kuwait's main index dropped 4.3%, with Jazeera Airlines shares falling as much as 10% due to airlines avoiding airspace over most of the region. Even Tel Aviv stocks opened lower by 1.5%. The Egyptian pound also weakened around 1.8% beyond 50 per dollar in local trades. The conflict escalated after Israel struck Iranian nuclear and military sites, claiming it was a prolonged operation to prevent Tehran from building an atomic weapon. Israel's defense minister, Israel Katz, stated his country's targets now include the regime in Tehran. Iran retaliated by launching attacks on Israel, targeting its infrastructure and energy facilities. Around Haifa, these tit-for-tat attacks saw 13 people killed in Israel and 380 injured by Iranian strikes, with at least 80 people killed in Iran. Crucially, Israel's strikes have directly impacted Iran's energy infrastructure. They've hit an offshore installation on the South Pars gas field, which Iran shares with Qatar and is the source of most of Iran's gas production. The Shahran oil depot in Qatran was also hit on Saturday, following earlier attacks on natural gas fields. The United Nations Atomic Watchdog reported serious damage to Iran's uranium conversion facility at Isfahan. The big question now is the worst-case scenario for oil markets. Analysts are closely watching for further Israeli strikes on Karg Oil Terminal, which handles over 90% of Iran's global crude oil exports. Crippling this facility would cause huge disruption, especially to China, the world's largest importer of oil, and send forward oil futures soaring because bringing it back online would be neither easy nor quick. Another severe scenario involves Israel attacking Iran's domestic energy supply chain. The Saturday hit on the Shahran oil depot lends weight to this tactic. Upscaling this tactic could involve targeting major clusters of oil terminals and hubs in the southern province of Hormozgan, which also hosts free trade zones on Kish and Keshem Islands. The domestically focused Abadan refinery, Iran's oldest oil processing facility, could also be a target, as it services around 25% of Iran's domestic fuel demand and holds symbolic status. Any outages there would be crippling for both Iranian consumers and the country's military. The Mashhar oil terminal, which stores and ships products from the Abadan refinery, is also a related target. Instead of oil, Israel could execute a plan to cripple Iran's natural gas industry. While Iran produces just over 270 billion cubic meters of natural gas per year, almost entirely for domestic use, and such targets would have little immediate ramifications for the global natural gas industry, domestic outages could force Tehran to seek alternative liquefied natural gas supplies, proving challenging under sanctions. For its retaliatory retaliatory measures, many ponder if Iran could attempt to shut down the Strait of Hormuz, a vital maritime artery through which roughly 30% of the world's traded oil passes daily. However, this is largely considered unlikely despite junior political voices in Iran calling for it. For starters, it would disrupt Iran's own oil shipments. Furthermore, a U.S.-led global retaliation would likely follow, leaving Iran's coastline and ports vulnerable to a vastly superior American air and naval strike arsenal, with the U.S. Navy's Fifth Fleet based in nearby Bahrain. Any disruption would also significantly irk China, Iran's primary crude oil customer, which receives nearly half of the crude oil passing through the strait. Alternatively, Iran could attack Gulf military bases or the energy infrastructure of neighboring states, either directly or via proxies like the Houthi rebels in Yemen, who remain capable of ramping up attacks on shipping in the Red Sea. Such a scenario is being widely contemplated in intelligence circles, with U.S. regional forces closely monitoring the situation. Any such escalation would trigger a wider regional war and prolonged oil cargo disruptions. The surge in oil prices to near 6-month highs poses a significant risk to the inflation outlook, affecting central bank monetary policy decisions globally. While a single spike might not derail policy, persistent oil-driven inflation could force central banks like the Reserve Bank of Australia to delay monetary easing and adopt a more cautious approach to rate cuts. For countries like India, Pakistan, Indonesia, and Bangladesh, which heavily rely on Middle Eastern oil, the impact could be severe due to limited strategic petroleum reserves and external balance pressures. China, while a major importer, has greater insulation due to diversified suppliers and substantial reserves, but sustained instability would still raise freight and insurance costs. Interestingly, Saudi Arabia raised its oil output before Israel's attack on Iran. While some speculated this was a response to White House pressure from President Donald Trump, who had warned of military options and sought to bring down oil costs, analysts suggest OPEC Plus also had its own reasons. The cartel's production cuts were no longer as impactful, and members like Kazakhstan were already exceeding quotas, frustrating Saudi Arabia, which had shouldered the majority of the curbs. Saudi Arabia was also wary of repeating the 2018 mistake when boosting output led to price drops after U.S. waivers on Iranian oil. Some analysts suggest Saudi Arabia's moves may have been less about Iran and more about winning access to American technology for its artificial intelligence build-out, civilian nuclear program, and defense sector. The broader market sentiment remains nervous, but not in a full-blown panic. U.S. stock futures were set to resume trading Sunday evening, and while the CBOE Volatility Index, often called the Fear Index, rose on Friday, it wasn't at apocalyptic levels. Some Wall Street sources even suggest that Israel's actions by degrading Iran's military leadership and nuclear capabilities could lead to long-term stability, lower energy prices, and new investment opportunities in the region, including the possibility of rich Arab countries finally recognizing Israel. They argue that Israel has largely eliminated Iran's proxies like Hezbollah and Hamas. As President Trump reportedly stays in the loop, distancing the U.S. from direct conflict while urging Iran to negotiate and end its nuclear program, the investment community watches for any black swan event that could deliver a peace dividend. Trump could also turn to the U.S. Strategic Petroleum Reserve, the world's largest emergency stockpile, if the oil price surge is prolonged. However, asking Saudi Arabia to pump even more oil would raise difficult questions for Riyadh, given Iran is an original OPEC member and the kingdom's recent détente with Arab neighbors. The situation is dynamic and constantly evolving. Staying informed is crucial in these volatile times. We'll continue to monitor these critical developments and their global economic implications as they unfold.